Stop looking at the spot price. Stop looking at the chart on your phone. It is lying to you. As of this morning, Wednesday, December 24, 2025, the global silver supply chain has officially snapped. While the paper price on the Comex is hovering around $69, we have confirmed reports that major industrial buyers, companies like Samsung, Tesla, and First Solar, are paying $82 an ounce for physical delivery. That is a $13 premium. That is a 20% disconnect. Why? Because they know what I'm about to tell you. They know that the registered inventory at the Comex, the metal that is actually for sale, dropped by 3.5 million ounces in the last 4 days. If that burn rate continues, the vault hits zero in 24 days. We are witnessing a hostile takeover of the physical market. The refineries have stopped taking calls from retail wholesalers. They have shifted their allocation to 100% industrial. This means the window for you, the retail investor, the stacker, to get metal is closing. The big boys are buying everything before the public realizes the vaults are empty. This is Silver Squeeze 2.0, but this time it's not a game. It's an industrial emergency. Today we are going to break down the Samsung protocol that started this panic. We are going to look at the Kvadden mining signal that the smart money is riding. And I'm going to show you why selling your silver at $70 is the biggest mistake you will ever make. Sit down, pay attention. This is the most important update of the year. Let's talk about this snap. What does it actually mean? Justo. Normally, refineries operate on a split. Maybe 60% of their silver goes to industry, electronics, solar, and 40% goes to retail, coins, bars for you and me. But in the last 72 hours, that ratio has shifted. Reports indicate it is now effectively 100% industrial. Why? Because Samsung doesn't negotiate. When Samsung needs silver for their new solid-state battery factories, they don't call up a dealer and haggle over 50 cents. They call the refinery and say, "We will take everything you have. We will pay $82 an ounce, and we will pay up front." Refineries operate on thin margins. If a massive corporation offers them a guaranteed premium and clears out their entire inventory in one transaction, they take the deal. This leaves the retail wholesalers, the people who supply your local coin shop, with nothing. I'm hearing reports of dealers quoting pre-order dates as far out as April 2026. Think about that. You pay today, you might get your metal in 4 months. That is not a market. That is a breakage. And here's the trap. The banks know this. They are trying to hold the paper price down. They are putting up what we call a gamma wall at 75. They are selling paper contracts to keep the price on your screen looking normal. Why? Because if the price on the screen hit $82 today, the panic buying from the public would break the system immediately. They are buying time. But the industrial buyers aren't looking at the screen. They are looking at their assembly lines, and they are terrified. Now, let's look at the fuel gauge of the silver market, the Comex inventories. There are 2 numbers you need to know, eligible and registered. Eligible silver is just sitting there. It's owned by someone. It's not for sale. It doesn't matter. Registered silver is the metal available for delivery. It is the only metal that matters. As of this week, registered inventory sits at approximately 24.8 million ounces. Does that sound like a lot? It's not. In the last 4 trading days, 3.5 million ounces left that category. That is a burn rate of almost 1 million ounces a day. Do the math, 24.8 million divided by 1 million. That gives us roughly 24 days. 24 days until zero. 24 days until force majeure. When that number hits zero, the Comex cannot fulfill its contracts. They will be forced to cash settle. They will send you a check for the paper price, but you won't be able to use that check to buy silver because the real price will be $100 or more. This is the holiday paradox we talked about. The banks are understaffed for the holidays, liquidity is thin, and the physical buyers are raiding the vault while the guards are on break. This is why we are seeing the holiday paradox explode. It's not just a rally, it's a run on the bank. Why is industry panicking? Why now? Because the Samsung secret is out. For months, we've been tracking the development of solid-state batteries. We knew they used silver, but we didn't know how much. New technical analysis of Samsung SDI's Ag-C Anode, a silver carbon anode, has revealed the number. To stop dendrites, the little spikes that kill batteries, and to enable 9-minute charging, you need a massive amount of silver. Estimates now suggest up to 5 grams per cell. In a 100 kilowatt battery pack for a luxury EV, that adds up to 1 kilogram of silver per car. Let's put that in perspective. Global silver production is about 25,000 metric tons a year. If just 20% of cars switch to this tech, it requires 16,000 metric tons. That is 62% of the entire planet's mine supply, just for cars. Forget solar panels, forget iPhones, forget jewelry. The car industry alone is about to eat the silver market alive, and Samsung isn't waiting. Their pilot lines in Suwon are active. They are targeting mass production for 2027. But to build millions of batteries in 2027, you have to secure the silver contracts today. That is why they are paying $82. Because if they don't, Tesla will, or Toyota will. This is inelastic demand. They cannot build the car without the silver. The price is irrelevant to them, but it is everything to us. So if the physical metal is disappearing, where's the next best place to put your money? You go upstream, you go to the source. This brings us back to the Kvadden signal we decoded, the merger between Dolly, Varden Silver, and Contango Ore. This is the most significant strategic move in the mining sector this year. Contango Ore has a gold mine in Alaska, generating $87 million in free cash flow. Dolly Varden has the Kitsault Valley project, home to some of the highest grade silver intercepts in the world. We're talking 1,122 grams per ton. They merged. Why? Because the smart money knows that in a supply crisis, the company with the high-grade rock becomes the kingmaker. They're using the gold cash flow to fund the silver drilling. They don't need to ask Wall Street for money. They are self-funding. This is a unicorn in the mining world. And while retail investors are fighting over ounces at the coin shop, the institutional money is buying companies like this. They are buying the ground. If silver hits $100, which looks inevitable given the Samsung math, the value of that in-ground silver goes parabolic. This is leverage. This is how you play the squeeze without paying the premiums. I need to warn you about what is going to happen in the next 48 hours. The banks are trapped. They have sold call options at the $75 strike price. This creates a gamma wall. If the price crosses $75, the banks are forced to buy futures to hedge their exposure. That buying creates more buying. It triggers an infinity squeeze. The banks cannot let that happen. So you are going to see spoofing. You're going to see massive sell orders appear on the screen to scare you. You're going to see the price slam down $2 in 5 minutes. Do not panic. This is an illusion. It is a digital trick to get you to sell your physical position. Remember, the industrial price is $82. If the screen says $68, it's a lie. It's a gift. They are trying to shake out the weak hands before the inventory hits zero. Don't be a weak hand. The supply chain has snapped. The vaults are draining at a rate that gives us less than a month of liquidity. The industrial giants have made their move. They have taken the physical market private. You have a choice. You can believe the paper price, or you can believe the reality of the empty vault. If you have physical silver, hold it. It is becoming a strategic asset. If you are looking at miners, look at the ones with high grades and cash flow, like the Dolly Varden Contango entity. We are watching history. The 40-year manipulation of silver is ending, not because the regulators woke up, but because the metal ran out. I will be monitoring the Asian markets tonight. If the Comex registered inventory drops below 20 million, I will issue another alert. Until then, stay stacking, stay strong. Class dismissed.